3,000 is your S&P target, and you're sticking with it. Are you stubborn or what?
No, I'm applying some common sense. I mean, there's three things. Number one, I plead with bond investors to stop making stock market calls and stock market investors to stop making bond market calls. Number two, just because everyone thinks we're going to have a recession doesn't necessarily mean we're going to have one. Saying we're going to have a recession is like saying the sun's going to come up tomorrow. Of course we're going to have a recession at some point. Now it all comes down to timing, and Mr. Najarian was absolutely right. You know, we were in the fear gauge yesterday. When you hear this 2007, 2008, anybody that's been in the market less than 10 years, they automatically go back to 2007, 2008. Let me be very clear. This is not 2007, 2008.
Right.
What happened in 2008
nobody
was a
here is saying
storm.
that it is. No, nobody here is saying that it is.
Well, I'm just saying, I just want to, I want to, no, listen, it needs to be said on television because what happened in 2007, 2008 was a perfect storm. We had a credit recession and a consumer recession hit at the same time. But point number three, from a common sense standpoint, don't let the facts get in the way of a good story. The yield curve matters when it inverts over a several week, if not several month time period. We had an intraday inversion yesterday. In 1998, we had a 27-day inversion between that started in May 26th. Between May 26th and the next time the curve inverted in February of 2000, the S&P 500 was up 29%. You have a lot of fearmongers out there telling people to sell everything today, and investors should not be making binary, fear-led decisions right now.
Look,
they should be focused on the best companies in the world, which are right here in the United States.
With all due respect to you and what you do, you could say that the bond market has been more right than the stock market. The stock market hasn't gone anywhere in the last year. The bond market has been screaming that there are issues in the global economy, that the trade war is real, and that the impact of the tariffs are having a bigger impact than the stock guys have been willing to admit. That's the truth.
Well, with all due respect to your Ricky Bobby comment to me, let me just throw it back to you. You actually wrote about it today. In terms of the momentum, the price momentum in bonds is actually what's causing this inversion. What does that mean, Brian? It means that dollar-denominated assets are the assets to be in vogue. When you have negative rates around the world, where else are you going to put your money? In terms of fundamental stability and earnings in GDP growth, it's the United States. So we need to be focused on those companies where the majority of revenues are coming right here in the United States. And again, while we believe Europe is the next Japan, we believe emerging markets is a volatile asset, we believe over the next couple of years is the place to be is the United States, and the bond market has all the money. Of course the momentum is going to continue there, and we think that from a longer-term perspective, now is the time when there's fear in the streets is when you should build your quote-unquote favorite Najarian baskets in financials, tech, and small cap, put them away for 5 years, and wake up and be very, very happy.